Good afternoon, everyone. Welcome to our webinar today, which is Startup Fundraising. My name is Sirk Roh, and I'm a consulting CFO with Early Growth Financial Services. And unfortunately, we typically have a moderator who kind of handles some of the initial messages. Unfortunately, we're having a little bit of technical difficulty, and she's not able to log on. So I'll just go ahead and introduce the webinar as well as just kind of get started here. Just as an initial message, for all of you who are online and have registered, we will be sending out a copy of this presentation to you within 24 hours after the webinar is complete. And so you should be able to see that, and you can refer back to it as needed going forward. But let's go ahead and just get started here. Just a little introduction about our firm. We are a financial services company that works with small and medium-sized companies. We provide accounting services for our clients, including, and you can see some of the clients that we have, but we basically provide 5 platforms of services. We do transactional accounting, what a typical bookkeeper and accountant would do. We provide CFO services. We do corporate tax returns. We do valuations for companies who provide stock options, so 409A valuations, for example. And we also do fund accounting and administration. And you can see some of the services that are included in those different buckets. And currently, we are supporting 18% of privately funded companies here in the United States. And just before we get started, a little bit about myself. Again, my name is Sirk Roh. I'm a consulting CFO with Early Growth Financial Services. I work with a bunch of different companies, many of them in the tech space, as you can imagine, being here in the Bay Area. But I also work with manufacturing companies, services companies, and I've been with Early Growth for about 6 years now. And prior to that, I was a VP of Finance and CFO at smaller high-tech companies here in the Bay Area. So let's go ahead and get started. Before we actually dive into it, let's just talk a little bit about kind of what this presentation is going to be. This is Startup Fundraising. And as you can imagine, that there's a whole gamut of topics that we can dive into. And we'll kind of briefly touch upon several of them. This presentation is more geared to kind of an introduction. If you are an entrepreneur and if you're kind of down that path of starting to fundraise, there might be some nuggets of information in here, but a lot of this may be stuff that you already know. And there will be topics covered in here where we do much deeper dives in other webinars. So, for example, there's some information about a pitch deck, and we do a full presentation on just what should be included in a pitch deck. We really can't go into that much detail here. Similarly, for things like putting together a financial plan that goes into your pitch deck, and we'll just kind of touch upon that here. But again, if you kind of go to our YouTube page or to our website, you should be able to find some past presentations that dive a lot deeper into some of those topics. So having said that, let's go ahead and talk about some of the reasons that we would want to raise funds. And here are the 3 main ones, right? It's to expand our network, it's to accelerate growth. And it may be, from a timing perspective, we really may need to raise funds to be able to meet some timing requirements, whether it's company-based or market-based. At the bottom here, we mentioned that this isn't necessarily for product and or market validation. This is something that you would probably do on your own, kind of prior to going out and raising external funds to just approve the product and prove what the market is like. Now, clearly, this doesn't mean that this is going to be the case for every company and every situation. Just depending on your individual situation, you may need to raise money before the market is validated, for example, or the product is validated. But for the most part, we're finding that entrepreneurs are spending more of their own resources to do that work, and then we go out and raise money to accelerate the growth, to be able to hire the people that we need to attack the space that we're trying to attack. So let's talk about some of the funding sources, and this is a very high level view. And as note on here indicates that these are tendencies and not hard and fast rules, but these are basically some of the funding options that we have relatively early on in the life cycle of our company, right? So at the beginning, during the ideation phase, this is kind of when you're going to be putting in your own money, obviously putting in your own time, but some savings that you have. This is where you're basically starting the business, and this is also a time when you may be talking to your family and friends about investing in your venture as well. That will be relatively early on in the life cycle as well, and we'll kind of touch upon upon some of the issues related to raising money from family and friends. And then after that is kind of where the meat of this presentation is with angels and VCs. So we'll talk about kind of the early stages of fundraising and the differences between angels and VCs and how you can target them. And then you got some of these other ones that are maybe a little bit later as the company gets going, and as we have sales and as we start working with vendors and customers. One of the key ways of financing our company is through operating functions, and so getting terms from vendors, figuring out how to get payments quickly from customers, and so some of those ways of financing our company, as well as venture debt. Venture debt is basically debt that we take from a bank or other lending source. That's a little bit different from angels and VCs in the sense that it's not equity and it's money that needs to be paid back. A little bit later, as we get a little bit more successful, and as we start doing more business, this is also when you might be able to talk with strategic investors, potential partners, big parties that may be interested in our business, our technology, whatever it may be. We may be able to go to them and get some financing from them, and then obviously if we have a lot of business going on, then we can get some good terms from banks and take additional funding from banks. Okay, so let's talk about the first one, which is friends and family, and we obviously skip over the bootstrap because that's kind of understood that you're putting in some of your own money to get this thing going. And with friends and family, the one thing that I'll mention here that I think is probably pretty obvious, but still bears mentioning, is you really want to be careful here, because typically friends and family are not institutional investors. They may be interested in hearing you out because they know you, they want to help you, but obviously you have to be a little bit careful about mixing family and friends with money, right? This is not the kind of venture where you are asking for a loan that you're going to be paying back in a very short amount of time. There's a lot of risk. You should make it very clear that any money that you're taking from friends and family is money that absolutely they can lose, they can afford to lose 100%, and not have it impact their lives, as well as impact the relationship that you have with them. Obviously, being very transparent about kind of the risks associated with it, the timing of what they can expect from a potential reward on the back end, but just making sure that they understand that this is money that they really should think about being able to lose 100% without it impacting their lives in any meaningful way. And then the top one, convertible debt being better than equity. We'll talk a little bit about convertible debt and equity a little bit later. Okay, the next set, and now we're going to kind of get into more of the equity investment that you're probably more interested in learning about here, is the difference between angel investors and VC investors. And with angel investors, there are several different, I guess, kind of groups or levels that you'll see. You got an individual angel investor, you have super angels, and then you have angel networks. So for angels, and this is kind of the classic high net worth individual who has either who has some family money, they want to invest, they may have been successful in industry and have retired or are still working, but they're interested in talking with entrepreneurs and investing in early stage companies, and that's kind of what a typical angel investor is. They tend to not necessarily be very sophisticated, and when I say sophisticated, I don't mean from a personal perspective or even a financial perspective, but from an investment perspective. They're not as sophisticated as a VC, for example, or venture capitalist. And so, their requirements are probably going to be a little bit different. The way that you talk to them, the way that you sell to them is going to be a little bit different than it would be for a VC or a more sophisticated or a much larger investor. And they tend to have smaller funds. They might do loans or equity investments of $25 to $50 to $100,000. The typical process to close a financing with angels tends to be a little bit shorter, several months instead of 6 months plus. And then having a point person, and we'll kind of talk about the way that you communicate with different types of investors in a little bit here. Super angels are a little bit more advanced and a little bit more sophisticated than angels. They probably have they make more investments. This is what they may be doing as their kind of their calling, as opposed to maybe doing it on the side like a regular angel investor. They kind of are more sophisticated. They know what types of investment vehicles there are. They know about convertible debt versus equity. And they're going to be interested in things like, okay, well, what kind of due diligence do we need to do? I want to know more about, not only about kind of what your ideas are and what your dreams are, but also I want to understand, what the payback is going to be like, what the term sheet is going to look like, how much money are we looking to raise, what are we planning on doing with that money? So the typical kinds of questions you would get from institutional investors like VCs, you'll probably start getting some of that with super angels. And then angel networks are kind of groups of angels that kind of pool their money together, and they make decisions like a group of investors. And because of the way that they're put together, you'll have access to bigger investments from angel networks as opposed to individual angels. And now we get into VCs, and before we talk about some of the different types of VCs, let's kind of talk about kind of the major difference between angel and VCs, because there's some overlap, right? I mean, if you take a look at some of the descriptions that I have for super angels, for example, versus micro VCs, you'll see that there are some similarities. But the main difference here between an angel and a VC is that angels typically are investing their own money, right? So this is an individual or a group of individuals who are pulling their funds together, and they're investing their own money. VCs are institutional. They raise money from the outside, so they may be putting in a little bit on their own, but most of the money that they're investing is coming from outside. They're coming from pension funds and other institutional investors, and they're pooling those investments and making investments on behalf of other investors, and that's kind of the major difference. So micro VCs is kind of the smallest group of VCs that you'll see. This is kind of a new breed. This is a kind of like a hybrid from like an angel group versus a VC. They may be more interested in an earlier round, they're typically not going to be with you for the entire life cycle of the raise. So you may be able to get them for a seed or a Series A round of financing, and then the expectation is that, assuming that you're successful, that you're going to be going out and talking with bigger VCs for Series B and Series C rounds of financing. They tend to be a little bit more operator sympathetic, meaning that that they tend to be more so than kind of other VCs who are very, very regimented about the paperwork, about the due diligence, about making sure that the reporting afterwards is done. That micro VCs may be a little bit more sympathetic to situations that you're going to face along the way, not only during the fundraise but during operations as well. The next group is corporate ventures, and you can see some of the names here. I'm sure that these will be very, very familiar to you, but these are VC groups within corporations, and they make investments. They may make investments from a technological standpoint. They may be making investments from a potential partnership standpoint. They may be making investments with an eye to potentially acquiring the companies that they're investing in the future. But they will make decisions typical of VCs as well. They will look at the investment, but not only from a pure potential return perspective, but also maybe with an eye towards, like I said, partnerships or acquisitions down the line. And definitely a good source of funds if you are able to attract them. And then, of course, before we get into the funding vehicles, the classic VC is what we've talked about before, where you've got institutional investors who are investing in these VC funds, and then the funds themselves are going out and talking to companies and finding good investments for them for their investors for long-term gains. So let's talk about some other funding vehicles as well. In addition to VC, there's also venture debt, and I kind of talked about venture debt a little bit ago. And what venture debt is it's unlike it's not a bank debt. So you're not like taking out a loan with kind of like this classic payback period with an interest rate that you're paying back over time. Let's say you take out a $100,000 loan and you're going to pay that back over 24 months with 6 or 8% interest rate or 12% interest rate. That's more of like a typical bank loan. Venture debt is actually a little bit different. Venture debt is debt that typically gets tacked on to a financing round, an equity financing round. And this is more of a long-term debt that you probably won't pay back for a good amount of time. It tends to be relatively expensive, but what it really does is it allows an entrepreneur to raise additional money in addition to equity. It extends the runway. By raising more money, it extends the runway, and you're able to do it by offering debt, which hopefully you'll be able to pay back with operations or with additional fundraising, and you're able to do that without diluting your equity. Right, and so that's kind of the big difference between equity versus debt. Equity, you're giving away part of your company to investors, and therefore you're diluting your equity in the company. Debt is money that's going to be paid back. So this venture debt will be paid back, but you'll be obviously paying interest as well as potentially a little bit of warrant coverage or a little bit of equity, but a very, very small amount. And what you're able to do is you're able to, like I said, the main thing here is that you're extending your runway with the raise that you're doing. And the last point here, based on VCs more so than your company, and let's kind of talk about that a little bit because it's kind of important. And that is that venture debt, the people who are giving venture debt, they know if they take a look at your finances, right, they're going to see that, hey, look, there's a good risk based upon looking at these financials that we're not going to get all of our money back. But what they're doing is they're actually making a bet. they're making a bet on not only you and the company, but also on the VCs, on the equity investors who are investing in your company, and knowing, you know, the reputation and the success that the VCs have had over time. You know, they're making a bet that the VCs are going to continue to fund your company, and thereby free up funds in the future to be able to pay back the venture investment or the venture debt investment. And so they have, you know, typically very, very strong relationships with VCs. The VCs will actually help sell the deal to provide venture debt to your company, and it's kind of this triangle relationship, which actually works out to everyone's advantage. But if venture debt is something that you're not familiar with, you should by all means you know, take a little bit of time to research it, because it really is a great option for many people to add some additional funds coming in. And then, you know, kind of getting back to the traditional venture capital, this is, you know, the classic VCs, the names that you're probably familiar with if you've been out there in the past looking for money for venture capital. They have, you know, lots of capital investment. They are, you know, they're going to be not only a funding source for you, but they'll also, you know, help you with your network. They'll introduce you to other partners that they have that might be able to help your business get going and to be successful. You can expect that they will exact both, you know, a fair amount of equity from you, as well as getting more and more involved. There's more red tape. Meaning that, you know, during the process of fundraising, that the due diligence effort will be pretty great. You'll have to sell yourself the investment to the company. There will be a lot of due diligence. After the due diligence, you can expect they will want to take active involvement. You know, probably with a, you know, in some cases they'll demand a board seat. You know, after the round of financing, they'll have increased expectations. There'll be more pressure put onto the entrepreneurs, as you can imagine, because they've put a lot of money into the company and they want to make sure that they are going to get a return. So you can expect a lot more scrutiny and a lot more management and supervision from VCs than you would get from some of these other sources. But obviously with that, you know, comes additional, you know, more and more funds that are available. Okay, and we just talked a little bit about convertible debt. Actually, we haven't, but I'm talking about convertible debt versus equity. So, you know, early on, the best way of describing it is that, you know, in order to raise an equity round of financing, basically you have to do a couple of things. You have to have a lead investor who will negotiate with you on terms. Right, you know, big terms such as, you know, what's the valuation of the company, and how much equity are we going to get? What percentage of the company are we going to get as investors, not only for ourselves, but the other potential equity investors who are coming into this round? You know, it tends to take a lot longer. It tends to, the paperwork is a lot greater. And early on, meaning that kind of at the first round of financing, which, you know, for most people on this webinar, probably you're looking at kind of the first round of financing. You know, that's a big hurdle to overcome. You know, we probably haven't been around for that long. We don't have a lot of traction. We don't have a lot of history to go on, which will help us to, you know, to be confident in the valuation of our company. And so for all those reasons, many early stage financings are done through convertible debt. And convertible debt is basically, you know, the best way of describing it is debt that you take on that ultimately is going to convert into equity at a later date. And by doing it this way, what you do, what it's enabling you to do is it's enabling you to raise a round of financing quicker with less negotiations, because there's only really a few terms that are negotiated, as opposed to an equity round of financing. And everyone is kind of, it's kind of fair, right? And we'll talk about why we think that that's fair, in later slides. But it's really a fair way of doing it, both from for the entrepreneur as well as an early stage investor. Okay, so getting into funding strategies. So this is kind of the game plan, and what we really want to do is we want to think about our business, and we want to think about raising money, and who we're raising money from. What is that money going to do? What are the milestones? And we're really, really big on milestone financing, so we're going to probably spend a fair amount of time talking about that here. How much money do we need to raise? What's that money going to be used for? And what kind of terms are we raising that money on? And those are, especially early on in the game, it's kind of hard, right? I mean, it's hard to know exactly how much money we need. And we may think initially about what we're raising the money for, but how much is it going to be, and when are we going to really need it, and who are we hiring, and how are we going after customers? How do we generate revenue? How much product development work do we still have to do? Those are the kind of questions that we need to understand about ourselves and our company before we're really, really able to put together a fundraising game plan. Okay, and let's talk a little bit about the fundraising process here. And this is one, again, kind of depending, like if you're early on and you're just, you're putting your own money in, and you're talking to friends and family about putting in, tens of thousands of dollars, that's one thing. But if you're talking about going after institutional investors, whether it's angel investors, whether it's VCs, then we're probably talking about a much longer process. And so please keep this in mind, right? So it's not one of these things where you can say, okay, well, I've been working in the background, I kind of put together this software, I think it's ready to go, I'm ready to go and raise money, and I'm just going to go out and pitch my idea to some VCs, and I'll pick and choose who I want, and it'll be a really, really quick process. It doesn't work that way. It's more of, it tends to be a long, drawn out process. For an angel investor or an angel group, it may take several months, 3 to 4 to 5 months, between initially talking with them and closing. With VCs, it tends to be longer, right? You should expect that it's going to take, at least 6 months, if not longer than that, to close around the financing. And even before that, there's obviously a fair amount of work that you have to do to ferret out your business plan and to put together your different documents and get names of investors that you're going after, and sending out presentations and executive summaries to those, and setting up meetings and networking to as many people as you can. And all of those things take a lot of time. And you should be kind of, even at the very beginning stages of your company, while you're working on product development and while you're working to acquire some customers, you should be, to the extent that you have a company that is ultimately fundable from an equity perspective, you should be, starting as early as you can, networking and meeting with people, meeting with investors, and meeting with potential investors, and working with some other partners that you have, talking with your bank, talking with your lawyer, talking with your accounting firm. All of these people are people who are potential sources of introductions to potential investors. And so, finding out who the potential investors are in your space, getting the list of those together, thinking about kind of your putting together your pitch deck and your financial plan, your executive summary. All of those things are going to take a lot of time before you're able to even go out there and start talking with investors and start talking with before you're even able to ask for introductions to potential investors. You should have all of this stuff ready to go, and you should be working on it, throughout your life cycle of your company. Okay, so choosing your target VC, and this is, I just kind of, mentioned it briefly in my previous slide, which is that, while you should be thinking about your who you're going to be pitching to, right? And because obviously, VCs and angel investors, they have their own ideas of what they want to invest in. It may be the size of the company, it may be the stage of the company, it may be industry focus. Some VCs will really only invest in software companies. So if you're kind of trying to produce some hardware, it may not be a good fit. Angel investors are a little bit different. Angel investors tend to be more, they want to have a one-on-one interaction with an entrepreneur. They may actually be investing in you as an entrepreneur, as opposed to the potential market size. So it's a little bit different. But especially if you're looking at VCs, you really, really need to be targeted, because you can't just blast your pitch deck to every VC out there that you can think of. They're not going to even open up that email without a warm introduction in most cases. And if you're being asked to be introduced to VCs, you should know a lot about them. You should already have a good idea that your company, both yourself as an entrepreneur as well as the product, the industry that you're in, are going to be good fits with the potential VC that you're talking to. And so these are some of the things that you want to look at, right? Whether what kind of expertise do they have? Where they're located, right? So geography may have an impact, on your desire to partner with a VC and vice versa. What kind of network do they have? Obviously, industry focus is a key one. But also even things like, beyond just the money that they're going to provide is, what else can they do for us, right? What kind of support can they provide? What kind of other introductions, can they be making to us, so that we are going to be successful in the future, because they're not just about a checkbook. Potentially they should be a great resource and partner to help you be successful. So let's talk about networking, and here we will. I'm sorry, I fell a little bit behind here on my slides. My apologies. But networking. So for networking, again, this is where you're going to be targeting, who your investors are and who your potential investors are. You want to make a name. You want to make a list of all the VCs that are going to be good fits for you. And keep a track of who you're talking to. Figure out if you don't know them already, figure out who in your network does. Figure out how to get introductions to them. Like I said before, if you just send an executive summary or a pitch deck to a VC blind, it's just not going to get looked at. It's not going to have credibility with them. Most VCs get dozens, if not hundreds of pitch decks per month, and they just don't have time to look at them all. And so you really do need a good introduction into them with some, from someone who knows you, from someone who either knows you personally, has worked with you, is working with you now, and can kind of speak to kind of what you're doing and the progress that you've made, and the reason why, why the VC should talk with you. And so you want to build that list, and you want to, figure out how to get introductions to them. Co-locations and incubators are really, really good spaces. We haven't talked about that. A lot of entrepreneurs, they may be just, one individual. It may be a partnership, 2 or 3 people, founders, that type of thing. And rather than working out of a garage, or a home office, which people used to do in the past, more and more entrepreneurs are using co-location spaces and incubators to really hatch their company, and those are really great places to interact with other entrepreneurs. Network with, find out, what kind of investors are investing, and they're just a great resource, and they tend to be really cheap as well, especially co-location spaces. And so, you want to look at those really early on as you're kind of getting started, because it's not just about, how, the little bit of money that you'll be spending to get into a co-location space, but it's about what the benefit is potentially of being in that space. Okay, so let's talk a little bit about what investors want to see. These are the three things that all entrepreneurs are going to need to put together, before they go out and actually start talking with people. So there's the elevator pitch, there is the executive summary, and there's the pitch deck. So the elevator pitch is that classic, how would you describe yourself? What is the vision, the dream that you have, what you're working on? If you get stuck in the elevator and someone says, so what do you do? This is kind of that quick, hard-hitting message that you have in the 20 to 30 seconds that you're in an elevator when someone asks that question, so that you're able to at least pique the interest, get your message across of what you're trying to do, and hopefully pique the interest of the listener so that they'll want to take the next step, right? So that should be a very well thought out, concise message, that is easy for you to communicate, and easy for the listener to comprehend and to remember. The executive summary is a 1 to 2 pager data sheet that goes into a little bit more detail. This has a lot of data, there will be some charts, but this is kind of that, when someone wants to take the next step and say, hey, send me something, send me a little bit of information, right? So this is where you'll, just kind of probably state the business, state the problem that you're trying to solve, how you're going about it, maybe the stage that you're at. You might put the team members down on here. You may just talk about your experience, how long the company's been around, things like that. Things that prior to sending out a full pitch deck, if someone says, hey, send me a little blurb about your company, I'm interested, or hey, I might know someone who's interested in learning a little bit more about your company, send me something about yourself. And this is kind of the executive summary. In most cases, this is the first thing that you'll send out to potential investors prior to, and then when they express interest in wanting to do a little bit of a deeper dive, that's when you'll send out a pitch deck and hopefully set up a meeting. The pitch deck is your slide set, right? So this is your presentation. So this is kind of what you're going to go over when you actually do have a face-to-face meeting with a potential investor, and this is kind of where you'll do the presentation, and we'll dive a little bit deeper into the pitch deck on the next slide. But this is kind of the classic 10 to 12 slides that you've probably heard about and read about, that you'll put together, that kind of really explains in more detail about what you're trying to do, and why you are going to be a great investment for a potential investor. So speaking of the pitch deck, and I mentioned at the top here that the pitch deck is obviously very important. It takes a lot of thought. It takes a lot of time to really put together a pitch deck correctly, so that it puts the best light not only on your company, but also on the way that you think, right? So this is, typically the first big thing that potential investors are going to see. You'll typically send this out, prior to you meeting with investors, and so this is kind of the main thing that investors are going to be looking at, and that you're going to be presenting. to investors. And so the way that this is presented, the way that this is prepared, the way that the flow of the information in the presentation goes is going to go a long ways towards earning the confidence of investors, which is really obviously what we're trying to do here. And because of that, and because there's a ton of interest in doing deeper dives into preparation of pitch decks, we've done, we in Early Growth Financial Services, we've done a bunch of different webinars. You'll be able to see different presentations if you go onto our YouTube page or our website, and I highly encourage you to look at that. And I'm sure that we'll be doing another webinar on pitch decks in the near future. So we certainly encourage you to sign up for that. But basically, these are some of the key slides in your pitch deck, and obviously this isn't comprehensive. You're going to have to kind of determine what makes sense for you. But there's some kind of high level takeaways that I want you to think about when you're putting this together. And some of those things are, so there's Guy Kawasaki, who's a legend here in Silicon Valley as an investor. He put together, or he created something called the 10-20-30 rule, which we really, really encourage you to do, right? And the 10-20-30 rule is basically 10 slides, 20 minutes, 30 font. Meaning, 10 slides is really the most that you want to put into your pitch deck. Now, of course, you're thinking to yourself, oh my gosh, 10 slides, there's no way I can fit everything that I want to say in 10 slides. And my answer to that response is going to be, you're going to have to figure out how. And I don't mean that that's going to be the entirety of your slide set. You're going to want backup slides. You're going to want backup slides on your financials. You're going to want backup slides if investors want to go into more detail about the market size or your solution, your technology. But at the presentation level, and what you're actually going to be presenting or giving to investors prior to you meeting with them, you're going to want to keep it to 10, maybe 12 slides tops. Okay, and you're going to want to keep them pretty high level. We highly encourage charts as much as possible. You don't want to do big old slides with a bunch of bullet points that are hard to read. And you're going to want to keep it high level and speak to the slides, right? The 20 is the 20 minutes, so you're going to want to keep your presentation down to 20 minutes. So basically 2 minutes per slide. And the reason we say 20 minutes is that typically you'll have 30 minutes for your presentation. VCs, when you originally set up time, they may set you up for an hour, but really, or in many cases, it's usually a half hour. They may want to run over, and that's a good thing if they're interested enough to want to go over. But you should plan on being able to present your presentation in 20 minutes. With obviously some time in between for questions or deeper dives as issues come up that investors want to dive deeper into. And then the 30 is the 30 font, right? So 30-point font. So you don't want to use anything less than a 30-point font. It speaks to a couple of different things. One is you being able to at a high level put your thoughts down and then speak to some of those bullet points if you're using bullet points at a deeper level during the presentation. You just don't want it to be an eye chart, right? Because you'll just turn off the investor. Either it's just too much information, TLDR, or the other thing is, again, kind of talking to the gaining confidence of investors. As you're kind of a salesman, right? And being able to sell your company to investors as well as to potential customers is really, really critical. And being concise and being able to communicate your value proposition quickly at a high level without diving into a ton of detail in writing is going to also earn the trust of your investors that you're someone that they want to invest in. And then in terms of the actual content, you can see here some of the the key slides that you're going to want to include. It typically starts with, what's the problem that you're trying to solve, and this is kind of how we're approaching it. You'll want to talk about the market opportunity, the size of the market. We use acronyms like TAM, which is a total available market, SAM, the serviceable available market, and SOM, which is a serviceable obtainable market. So those are kind of like the three big, circles that you see there. You'll talk about your go-to strategy, right? How you're going after it. Are we going after it through social networking? Are we going to do traditional advertising? Are we going to do, online advertising? Is it a local market? Is it a national, regional, national, international market? So those are some of the things that you want to, think about and be able to communicate. The technology, or kind of the secret sauce. Our secret sauce is, basically, why our technology and our solution is going to be better than everyone else. You'll want to put together a competition slide. Typically the competition, there's two classic ones. The one that you see here is kind of the check mark one, where you put down, benefits or features along one axis, and then of course, we check off all of those, critical benefits or features, and some of the other competitors, only hit some of those. And then you also have kind of the axis-driven one, where you have an XY axis chart. Where you have, two different things that you're looking at, maybe like value versus cost or time to market, and you want to put ourselves in the upper right quadrant, right? Being the best in both axes compared to our competition. So those are the classic ones that you will see. But to the extent that you can think of a better way to communicate where we stand in relation to competition, then obviously you should go ahead and use that. You'll want to put together some financials. So we'll talk a little bit about kind of financial planning here at the tail end of this webinar. But basically, you're going to want to communicate, how much money we're going to be spending. When does the revenue hockey stick kick in? How long are we going to continue to lose money? When do we break even? How much money is needed, until we get there, and so on and so forth. The funding requirements is the call to action, right? So this is one where we basically say, hey, look, this is the money that we need, and this is what we need it for. And here we'll talk a little bit about, and I'll mention the one of the key things here, which I alluded to earlier, which is milestone financing. But this is basically, you're saying, look, we are trying to raise $1.5 million of seed financing. We're going to use that $1.5 million for X, Y, and Z. Hire these people. Go after this customer base. Spend this much in marketing and advertising. Increase our product, or improve our product, or finish our product, whatever the case may be. And basically letting them know what you're using the money for. And then the milestones, obviously this is kind of, these are the key milestones that we are trying to achieve. And I want us to really think about milestones from, and basically couple that with your financing ask, or the amount of money that you're asking for. And this is why. So if you think about kind of, the life of our company, what's going to happen is this: we're going to go ahead and get our company started. We're going to be, not taking any salary. We're going to be doing it on our own. We're going to be developing our product, really trying to, talk with potential customers, see what the market's like, get a little bit of traction, and then we're going to raise money, right? Well, what we want to do is we want to layer the amount of money that we're raising against milestones that we're trying to achieve, right? Because what happens is the valuation of our company over time, hopefully, is going to increase. And it's not gonna increase on a linear function, and it's not gonna increase even on a curve or even a quadratic function. It's gonna be more like a step function base, right? And so what's gonna happen is that our valuation may start off very, very small, but hey, boom, we finished our product and we're coming to market, right? That should jump our valuation up substantially the day that it happens, right? We may get to a number of eyeballs or a number of customers or amount of revenue base, and that's a milestone that we're trying to achieve. And when we achieve that, basically we're showing traction. And when we show that traction is there, that also increases our valuation in a stepladder function, when that happens. So basically what we want to do is, to the extent that our valuation is increasing over time, we want to raise money to allow us to meet those milestones, but we don't want to raise so much early on that we're giving up more of our company at an early stage when we're less valuable, when our company has a smaller valuation. And so what we want to do is we want to say, okay, look, we're at the stage now, we're basically just finishing our product, we're ready to really start our marketing efforts and hire a couple of customer service people, and that's what we're raising money for. And we need, $1.5 million, for example, and that's going to get us 18 months out. And in that 18 months, this is the milestone. This is the next set of milestones that we are trying to achieve. And if we hit those milestones with this money that we're trying to raise today, then we expect our valuation is going to be much higher. The investment that the current investors are putting in today is going to be worth much more, and we're going to be much more successful down the line. And during all of that, we are giving up less of our less equity of our company, through multiple raises of financing. And I hope that makes sense. And if not, obviously we can answer questions. But that's kind of a key thing that you want to think about, throughout this process of raising money, is the timing of the raises, the amount of the raises, and the milestones that we are trying to achieve with that money. And then the final slide is obviously a little bit about the management team. Having a team that is not only yourself, but you may be a technologist, or you may be a sales and marketing person. Having a co-founder who is better at the other side of it, right? The marketing side of it, the operations side of it. Having a team that understands the space that you're going after, whether from previous experience, technical expertise, what have you. Obviously, one of the key things that investors are going to be looking for is not only the market opportunity, but are you and the founding team, are you the ones that they want to put the investment down on? And this is where you kind of play that up. Okay, and then of course, we'd be remiss if, being an accounting and finance company, to not talk a little bit about financial slides. We get this question a lot, right? We get this question of, I don't know how to put together a financial model. Is just putting together a revenue slide, is that sufficient, or is it do we need to put together a full financial model? Do we need to put together an income statement? Do we also need to add a balance sheet on there, a cash flow statement? So these are some of the things that we get, questions that we get, and so we'll kind of try to talk about that here a little bit. And the main things that you want to look at are obviously revenue projections, and then kind of to fill out the rest of the P&L, in terms of the expenses, the resources that we need to make that successful. And put together a full P&L. But in addition to that, we highly encourage you to also look at other use of cash, rather than just the expenses and the cost of goods sold that you're going to be generating, because there's other potential cash requirements. So for example, if you need a lot of hardware, if you need to purchase a lot of hardware, then CapEx is a funding requirement that you need to make sure that you take into account. Are there other investments that you're going to need to make? So these kinds of things tend to turn into gotchas if you don't think about them in advance, and if you only look at the income statement. And so we encourage you to kind of look at your financial picture at a holistic level. Okay, there's two kind of main ways of doing financial projections. There's a top-down and there's a bottom-up. from a top-down perspective, this is kind of where, if you don't have a lot of history, if you don't, and so we don't have like, growth rates to go on, then putting together a revenue plan, looking out 3 years plus is obviously very, very difficult. And so this is kind of where we, do the best that we can to put together, what we think we are going to be able to generate in terms of revenue. And so you kind of start with that market size, the total available market. And depending on the industry you're in, there'll be lots of different places that you can get to try to estimate that over time. You want to identify particular segments that you're going after, right? So the total market size is not going to be your initial market that you're going after, right? So a classic analogy is like the sushi market, right? Sushi market may be $2 trillion per year, but if you're opening up a sushi restaurant here in San Jose, then obviously your total available market or the serviceable available market is maybe a 10-mile radius from your restaurant. And so you want to identify particular segments that you're going after. And you may layer on additional segments over time, right? But at least start with, what the assumption is as to the market that we're going after, right? And then you and then you say, okay, and from this particular market segment that we're going to be going after, I expect that we're going to be able to generate this kind of revenue, right? It may be a market penetration percentage. It may be, based upon like, what kind of growth we really can even achieve. You may use some statistics, some SaaS statistics like, customer acquisition cost and lifetime value, those kinds of things if you're a software company. But those are all kinds of things that you'll want to use to try to get to a potential revenue over time. That's kind of the key thing that we're trying to get to here. And obviously, with the right amount of documentation and backup and analysis to be able to support it. And then once we have kind of the revenue projection, then we kind of do more of a bottom-up financial projection to say, okay, well, based upon kind of what that revenue target is over the next 3+ years, then this is what we're going to need to spend in order to be able to generate that revenue, right? So it's probably going to be things like, what kind of heads do we need, right? Do we need to hire salespeople? How many more engineers do we need to hire? What kind of additional features are we trying to add on to our product or service? What kind of advertising and marketing spend are we going to need to spend? What kind of CapEx, like I said, what kind of CapEx do we need to be spending on? And so all of those kinds of factors go into kind of the bottom up, to be able to kind of fill out the rest of that P&L, as well as additional cash that's required that falls outside of the P&L. So the balance sheet, for example, like I mentioned, CapEx, inventory. If you have to carry inventory, you'll probably want to make sure that you have enough cash to cover inventory purchases and things of that nature. So all of that kind of rolls into what the expenses are going to be needed, and ultimately how much cash is needed. And now if you kind of layer that, if you kind of put that side by side with our milestone financing or milestones that we're trying to hit, then hopefully all of that kind of comes together in this nice little triangle that suggests that this is our financial model. Put a little bit of fudge factor in there for the fundraising, and then say that this is how much money we're looking to raise. It's going to take us this long, and these are the milestones that we're going to achieve, and we have the confidence that we're going to achieve that. And then and then finally kind of going back to the funding requirements. So this is the ask, right? So how much are you looking to raise? Make sure that you communicate that, make sure that it's in the ballpark of the investors that you're going after, whether it's an individual investor or a group of investors. If you're going after VCs, typically you'll find that VCs don't like to invest by themselves in any round of financing. So you're going to want to put together a group of VCs that work as a group to do the full raise. So understand what the VCs are comfortable, what range of investment they are comfortable in at the stage that you're investing in, and make sure that you're talking to enough VCs so that you can put together a group of investors that they'll all rally around. So, we talked a little bit about don't raise too much. I know for many of you that seems ridiculous. The idea is to raise as much as possible. But really, if you're in a position to take on a lot of money, if you really have a great value proposition, and if you're able to get the interest of investors, you may end up, looking at a situation where, where you have an opportunity to take more money than you might need. And you really, really want to be careful about that. So kind of, do your, make sure that you're taking on the right amount for the stage of the company that it's at. And so, so I hope this was helpful. Obviously, to the extent that you have any questions, I apologize. Like I said, typically our moderator fields questions during the presentation and feeds them to me. We just didn't have her available today due to technical difficulties. But you can see here our contact information. We absolutely encourage you to reach out to us if you have additional questions or would like additional information about some of the topics we covered here. Likewise, again, if you kind of go to our website or check us out on YouTube, there will be a ton of other information out there, presentations that you can also look at. And then finally, as a reminder, and to repeat myself, we will be sending out this presentation as well as an audio recording of this presentation to everyone who registered for this webinar within the next 24 hours. So thank you all very, very much for taking time out of your busy schedules. We certainly appreciate it, and we hope to talk with you next time.